I'm usually asked by first-time home buyers, what is a rate lock? So a rate lock is a promise from your lender to lock your rate for a specified period of time while they process your loan. And the reason that they do this is to protect you from rising interest rates. Now, if you lock your loan with your lender, you may be eligible for what's called a float down. A float down means that if interest rates drop, you can get the lower interest rate. However, I do have to warn you that a lot of lenders will not honor a float down unless there's a sizable drop in the market. So I'll give you an example. Let's say hypothetically that you lock a rate in at 6% and the market shifts downward and now rates are 5.875. The lender most likely is not going to honor a float down because it's a very small drop. But let's say that overnight there's big news and mortgage rates drop to 5.5 from 6%. That is most likely going to be a big enough drop that a lender would honor a float down. So what happens if your rate lock expires? Well, every bank has their own guidelines based on rate lock expirations, but every bank that I've ever worked for in the over 20 years that I've done this will subject you to worst case pricing. And what that means is, let's say again that you locked your rate at 6% and you allow your rate to expire and now rates are 6.5. You will be at 6.5%. On the flip side, if you locked your rate at 6, you let it expire and now rates are 5.5. Most likely you're going to be stuck at 6. So it's always better to request a float down or to do what's called an extension. Rate lock extensions happen when the processing of your loan will not be completed on time. And that's not necessarily the lender. It could be acts of God. For example, a hurricane could come in and potentially that could slow things down because now lenders have to verify that the property is not damaged. So an appraiser has to go back out, re-inspect a property, and if something like that happens, it can delay your closing. There could be other things. There could be wildfires, natural disasters, or maybe the seller is not prepared to close on time or the buyer is not prepared to close on time. If that happens, rate lock extensions are common, but they do typically come with a cost. The cost will vary from lender to lender, but they're usually pretty close. So you have to speak to your loan officer to find out what the cost would be for a rate lock extension. Now, if you're buying new construction, some lenders, not all, will offer what's called a long-term rate lock. And a long-term rate lock, just like it sounds, will lock your rate for a long period of time. Typically, 90 days is going to be the shortest term under a long-term rate lock, and a lot of lenders will go up to 1 year. And so typically the way those work, and again, every bank has their own rules, typically they will require an upfront deposit, and that deposit can be anywhere from 0.5% to 1%, typically. And in most cases, at least from the banks that I've worked with, that money is refundable as long as you close your loan with that lender, or if your loan gets denied by an underwriter, they will refund the money. But as a consumer, if you just choose not to close with that lender and go with a different lender, then oftentimes that money is not refundable. Once again, disclaimer, every bank has their own policy, so there is no one answer to the long-term rate lock. And again, not all lenders offer those. If you have any questions, feel free to leave comments in the section below, or you can always reach out to me via phone or email. I hope you found this video useful.